Welcome back, everyone, and we are very excited for the last event of the day, our keynote speaker, Laura Veldkamp. And I'd like to invite Kevin Styro, who's the head of supervision at the Federal Reserve Bank of New York, to introduce Laura. Over to you, Kevin.
Hi, can you hear me okay, Sonny?
Yes, I can hear you.
Thanks very much. Great. Well, thanks for the opportunity. It's a real pleasure to participate today in the second Federal Reserve Bank of New York conference on FinTech. The intersection between finance and technology, better known as FinTech, is a critically important topic for the financial sector broadly and for the New York Fed in particular. We all look around and can see the ongoing transformation of financial firms as they invest in data, technology, and new applications. This includes everything from anti-money laundering surveillance to new marketing and pricing of products to automated financial advice from bots. Firms are making massive investments in rethinking how they understand their customers and how they should reconfigure their business models. As central banks, we need to understand how firms are developing these tools, how they are using data in novel ways, and how they are innovating in the provision of financial services, all of which has clear implications for our core responsibilities around monetary policy, payments, and supervision. To help us understand these developments, we are very fortunate to have Laura Veldkamp here to join us today. Laura is a professor of finance at Columbia University's Graduate School of Business. She was also a co-editor of the Journal of Economic Theory. She's a faculty research fellow at the NBER and the Center for Economic and Policy Research, and she acts as a consultant for several reserve banks, including the New York Fed. Laura has a broad research agenda across macroeconomics, microeconomics, and finance, and one common theme is her focus on data, information, and knowledge, how it's produced, how it's used, and how it's valued. The continued expansion of how data, information, and knowledge are used is really one of the defining characteristics of the FinTech ecosystem and all the innovations that I mentioned earlier. So Laura, thank you very much for joining us today, and we're very much looking forward to your insights.
Great. Thank you, Kevin, for the generous introduction. So today I'll be talking about data and modern financial questions and in modern financial markets, some tools and some questions. And this is based on joint work with my wonderful team of co-authors, including Simona Abis, Mariam Farboudi, Adrien Mate, and Venki Venkateswara. And next. So, I don't think I need to convince anybody who showed up for this conference that data is at the heart of a revolution going on in financial markets. It's really exciting, but it creates a new role for theory. So the finance theory 2.0 is going to have to wrestle with issues like data portfolio choice, right? So we have lots of literature now on how we choose assets, given, if we think that this is the, future expected cash flows, for example, how do we form a portfolio of risky assets? That's well established. But now the question is, well, but what portfolio of data should we choose that will lead us to have knowledge of this or that, that will then subsequently result in us holding a particular portfolio of assets? So as we become more knowledgeable and data is becoming a bigger deal, we can step back finance theory one step and say, well, we know how to choose the assets given what we know, but what should we choose to know? Right? And similarly, there are going to be issues of data valuation. We've got a ton of theories now about how to value assets given beliefs about what's going to happen in the future, but those beliefs about what are going to happen in the future depend on the data we acquire and how do we value that data, right? And similarly, there's lots of finance work out there on asset market intermediation, and how assets are intermediated depends a lot on who knows what, right? Who's better informed. And so this raises questions similarly of data intermediation. So what I want to do is talk a little bit about, how do we think about these changes taking place through the lens of what kind of frameworks might we want to use to address these classic finance questions, but instead of talking about traditional assets, we're going to talk about data as an asset. So there are many ways, in fact, to value financial data, but one is that we can infer how much data each firm has from looking at who they hire and how much they pay those people, right? And how much they value that data should be related to the wages of the people that they pay to work with it. So that's one approach I'm going to explore. Another approach I'll explore is we can calculate how much extra return you could earn from a given amount of information, right? And so that'll be, for example, looking at asset market prices and returns rather than looking at labor market evidence. And there are a lot of other approaches as well. So today I'll give you a couple of ideas, and I'll present lots of open questions in each of these parts. So hopefully I'll give you, lots of ideas for new directions that we might go. Next. So the first part of the talk, I'm going to be addressing the question, how is data used to create knowledge? So many of us have heard the claim that big data technologies are like the industrialization of knowledge production. So we're going to look at that with a skeptical eye and say, is that claim accurate? So if we want to know whether it's like industrialization, we should measure it like people did industrialization and see. So the spirit of this model is, let's think about knowledge production, very similar to how people have thought about goods production in past research and over the course of the last few decades or even the last half century, and see what we get. So key feature of what does it mean to be like industrialization? The key feature is it changed the relative intensity of labor and capital, right? When we think about production, it went from an artisanal craft-based production to a big factory. What we think of is that artisanal worker had lots and lots of labor inputs, and they couldn't benefit a lot from a ton of capital. They had really quickly diminishing returns to capital. And so industrialization reduced the diminishing returns, right? So it increased the marginal benefit of capital. And so we're going to think about the same thing going on with knowledge production, that it changes the relative intensity of labor. And this time, instead of capital, we're going to be talking about data, right? So the question is AI doing the same kind of thing that industrialization did in the goods production a century ago? And this matters a lot. How much diminishing returns there are to data. That diminishing returns parameter tends to govern just about everything. It matters for how much employment, what's the optimal scale of the firm. It matters for the labor income share, right? So it's going to be related to questions of inequality and how much of the pie data owners get versus workers. It'll be related to competition, some issues that we've heard come up in the previous talks today. So we're going to try to take a look and measure, is AI changing the diminishing returns to data and thereby changing the diminishing returns to labor? And we'll look at that in the context of the finance industry. So investment management is a really good laboratory for thinking about this because it's a knowledge industry, it's an early adopter of AI, it's pretty easy to identify what are the objectives and what are the tasks that people are doing. And so we're gonna take a look at that as a microcosm of what might be going on, at least eventually, in the larger economy. So we're going to write down a model. This is going to be an estimation, but it's a structural model estimation. And that model is going to start with some raw or unstructured data. And that raw or unstructured data is going to require some processing. And processing involves cleaning, structuring, and warehousing the data. So it turns out that a lot of work at companies that use a lot of data goes into making that data usable. And that if they get some raw data, it's not particularly valuable to them if it's not in their system, if it's not queryable, it's not mixable with the other kinds of data they have. So once you get that structured data, we're going to think about there being some labor involved in analysis. So somebody has to turn that data into knowledge. And there'll be two ways of doing that. One is with old technology. So we use old to mean that traditional finance kind of approach that people would use. And it could be with a new technology. And we'll call that AI. And AI doesn't really just mean, I'm not talking specifically about artificial intelligence. I'm just using that as a convenient acronym to really mean a whole suite of data technologies that involve the intensive use of large amounts of data. Next. Kathy, thanks. Okay, so this is a model that we're going to estimate. So knowledge is going to be produced using either an old technology or a big data technology, which we'll shorthand by AI. And the same data can be used for both, but I'll come back to that in a second. The technologies have different rates of diminishing returns, and they use differently skilled data. So KAI, so K here is knowledge, not capital, but knowledge, is a production parameter, A, that's specific to AI, and it could be changing over time, right? We're probably getting better at AI analysis over time, so we're going to allow that thing to drift. DIT is the amount of data firm I is using at time t. It's raised to an exponent alpha, and LIT to the 1 minus alpha. Okay, so this is a form of a Cobb-Douglas labor technology where 1 minus alpha is the labor share of income. And the same kind of thing for old technology, except they're going to have a different productivity parameter, AOT, and they're going to have different exponents, right? So that's saying that the rate at which the returns to data decrease for old technology could be different than the rate, that would be gamma, than the rate alpha, which they decline for artificial intelligence. Now, one way to think about this declining returns to data is there are different kinds of data, and you could imagine ordering them from the kind that's most amenable to AI analysis or old tech analysis, and then they subsequently become less and less usable or valuable or relevant or so forth. And so what's happening as we use more data is that we're moving down the value chain, and we're using less and less appropriate or valuable sources of data. So data inputs are not raw data here. This is the processed data, the structured, clean to warehouse data. And making that structured, clean to machine readable data requires a bunch of labor. And we see that very clearly in the hiring data, that there are a ton of these kinds of jobs out there that do this. And that production turns the raw data into structured data with its own diminishing marginal returns. So new structured data is going to be added to the existing stock of structured data. It also depreciates. So this equation 3 at the bottom looks just like a capital accumulation equation, where capital, in this case, is data at t plus 1, is depreciated data at t, and then this last term, which is investment. How do you invest? Well, you invest by hiring these data warehouses, and they have a productivity ADM for data management. Next. So from this simple 3-equation structure, that's really all we need. We can construct a firm's value function, because you want this is a recursive value function. It's a Bellman equation. And the reason that you need that in this context is the data here is a long-lived asset, right? So when I hire some data management workers to make this nice structured data set for myself, I'm giving myself more data now, but also forever in the future, right? It'll depreciate, but it'll still be around 2 and 3 and 4 periods from now, just like capital is. So we want the same kind of recursive problem to think about. Well, how do I value data today? Well, that depends on how much I'm going to produce today with that amount of data. That's kind of what's on that first line. How much am I going to make in profits from producing with that amount of data? But also, how will I value that data in the future, right? And that's the second line of equation 4. So using this recursive process, we're going to be able to say something about how a firm values data. And then there are these 3 first-order conditions that come out of the model that basically say the labor share of income is 1 minus alpha times capital for AI, times knowledge, the value of knowledge generated. And the labor share of income for old technology is 1 minus gamma. And then we've got this piece for the amount that you should be hiring data management workers. Okay, so they are what they are. I'm not going to break apart every term, every symbol in this equation, but just to say that what we're essentially doing is writing down a simple 3-equation model and saying firms set marginal benefit equal to marginal cost. And so what marginal cost is going to be is the wage you have to pay a laborer, right? In each of these, an AI worker, an old tech worker, data management worker, and then we get to see those because we see the wages, the number of those people who we're hiring, and then the marginal benefit, we're going to get that from saying it's got to be equal to the marginal cost. And then the question is, how much does that marginal benefit of data change if they've got more data or less data, right? And that's where we see diminishing marginal returns. As that marginal benefit goes down, once they've got a lot of it and it goes down really rapidly, we're going to say that's strongly diminishing marginal returns. Okay, so the goal here is to identify the exponents, alpha, gamma, and phi, that govern marginal returns to data. Okay, next slide, please. Okay, so the primary data we're looking at is job postings and salaries from Burning Glass. This is 507,000 job postings in investment management, of which 143 are categorized, 143,809 are categorized as AI, old tech, or data management. So there are a bunch of job postings that don't seem to fit any of these categories very well, and we're going to toss those aside. So that gives us 33,000 non-zero employer month observations for 928 companies. Okay, so key step is how do we categorize these job postings? And this is tricky because what these investment managers are doing using AI or old technology looks like very similar jobs. And so we actually had to go to the full text of the job posting, not just using the skills listed by Burning Glass, but actually go into the text of the job postings and do some textual analysis on those underlying original job postings to figure out what's the probability they fit into each of these categories. But what you see in these three things, these three figures, word grams in the bottom, is what are the words associated with each of these kinds of jobs. So the first one, that little robot guy, that's the words that are common in the job postings for AI skilled analysts. The middle picture, the human, are the words that are most commonly associated with an old technology analyst. So there's things like portfolio management and statistics and analytic skills and financial modeling, and right, because the people are doing the modeling as opposed to the AI algorithm figuring out what's the best model. And then the third one shows you what do data management jobs look like. So they've got words in there like data manage, info systems, SQL servers, data govern, and so forth. Okay, next slide, please. Okay, so what our model talks about is numbers of workers, right? If we were to see the production function, we would see the total labor stock. And what our Burning Glass data is giving us is number of job postings, right? And so we got to accumulate those job postings, and we got to account for a couple of problems. One is not every job posted will be filled. And the second is some people who are hired will be fired or quit or leave for some reason. So we're going to use separation rates that are posted from BLS. They're going to match this type of job. So we're going to use separation rates that are specific to AI jobs, old tech jobs, or data management jobs that are going to match the NAICS code by type of job. And then we're also going to use the fraction of posted vacancies filled, also from the BLS with the same sort of matching criteria. And so using that, we can say, okay, if we take some stand on what the initial level of employment was, we can add up all of these new jobs posted, accounting for the fact that not every posted job is filled and that not every worker who was with the firm stays with the firm. That's what 5, 6, and 7 are about. And then we got to deal with the question that, like, at the beginning of our sample, what is that initial amount of labor? So we've tried a bunch of different possibilities here and found some that seem to give sensible responses and not big jumps at the point where we start our accumulation algorithm. But in any case, we use the first 4 years of our data as a burn-in so that we're not too sensitive about what the initial assumptions for labor stock are, and we start our estimation in 2020. Next. So here's the raw data that we see. This is the growth in employment in these three kinds of jobs. So on the left, you see all three kinds. On the right, we've just zoomed in on the blue line at the bottom of the left panel because it looks kind of flat just because the numbers are a lot smaller. So, and the first thing you see is AI is still a pretty small fraction of hiring, even in this market, even though these are the early adopters of this technology. And when finance wants an AI worker, finance usually hires an AI worker, much more so than in other industries that don't pay as well. So what we see lots of hiring in is data management, right? That's really exploding. And we still see healthy hiring in old technology. So in 2010, 5% of the employers in our sample hired any AI workers at all. In 2018, 30% did. So there's an enormous increase in hiring, not just the number of jobs, but the breadth of firms that are hiring these kinds of workers. But what we don't see is it doesn't look like this is crowding out old technology labor. So we do some extra work to try to check that. And that's consistent with what researchers in economics like Asimoglu and Restrepo have found in other industries as well. Next. So these are the main results. I said what we're primarily interested in is what are these exponents, because that tells us to what extent has AI changed the production of knowledge, right? And so alpha is that exponent for AI, gamma is that production exponent for old technology. Okay, so we're comparing those two. And then the three columns here are different rates of data depreciation. Obviously, it's not possible to get a really good grip on that directly. If anybody has good ideas about how to do that, I'm all ears. So we made some different assumptions ranging from 1% per month, which would be a very mild rate of depreciation to 10% per month, meaning like almost every year your entire data set needs to get recycled. So 2.5 is our baseline, but in all three of these cases, you can see that there's a really big difference between AI and gamma, and that alpha exponent, the AI production exponent, is significantly higher than gamma, the old technology exponent. And what that means is that there's less diminishing returns to data because of AI, which is logically what we thought, but the magnitude is big. So people who've done similar exercises around the time of the Industrial Revolution, looking at this exponent for capital, obviously, rather than data, estimated something like a rise of 0.122 in the capital exponent during the Industrial Revolution. And this is an increase of 0.174, right? So it looks 50% bigger, almost, than what we saw at the time of the Industrial Revolution, at least in this data management industry at that time. So this looks like a really big change. And that also means that we might see big shifts in the income shares of workers and data owners in this industry. Next. So one of the things you get out of this is that there's then a rising value of data. So you can see this is the cumulative value of data over time. We're starting in 2015 and going up to 2019. We're working on getting that last year of data out of burning glass to extend this even a little bit further, but there's clearly a strong upwards trajectory here. And this comes from a few different sources. It's coming from the fact that there's a larger, you can go forward one time. It's coming about because a larger data stock they're accumulating data, and so there's just more data, and therefore it has more value. This is also happening because more analysis workers, right? There are more old tech workers and more AI workers. So if we've got more workers, that makes our data more valuable. And the third is firms are becoming more productive at using data. So I had these technology terms, AI, and AOT, that were in front of the production functions. And what we see is that brown line is the productivity of old technology analysis. And it's pretty flat, right? Not getting worse at it, but we're not really getting any better at it, right? Financial modeling is financial modeling, and we're kind of doing it the same way we were 20 years ago. But AI took this big jump it looks like at the end of 2016, beginning of 2017, and we seem to be on a higher level of knowledge productivity using AI technologies. Next. Okay, so there's still a lot of open questions. This was a really simple model, right? And it doesn't answer things like, what is this data about? So it could be about asset fundamentals. It could be about sentiment. Maybe some of what they're collecting is Twitter feed to see how we're all feeling about, the economy right now, or, whether, noise traders are going to go on a buying spree or not, or whatever. So, my recent work, just published this year in the AER with Mario Forbuti, looks at how you might think about that sort of trade-off, but that's not here in this measurement exercise yet. So it might be interesting to, try to merge those tools. And similarly, you could ask about, which assets and which industries do you think data is being acquired about? And there a natural tool to use is rational inattention. I just want to point out that we've adopted rational inattention for economic kind of questions, but it originally came out of a computer science literature, right? And this idea of entropy and information allocation was originally designed to think about allocating data to different communication channels. So now as we go back to think about data, it's a really natural tool to apply once we think about data allocation questions, which these are. You could also ask questions like, if firms are getting much better at AI and it seems to be producing value and it's generating more knowledge, what are the barriers to its adoption, right? We'd be interested in how do we forecast future adoption. Questions like, does data valuation implied by what the kind of exercise we just did, where we're using hiring data, does that line up with the kind of data implied by intangible capital metrics? So I'm thinking of like work by Creuset and Eberly, right? They're looking at intangible capital. If we think a lot of that might well be data, are these things the same order of magnitude, right? So let's use different kinds of techniques and see if we arrive at the same conclusion. And does data measurement implied by hiring accord with price implied information measure? So I'll look at that next. So the next piece of this talk is, how does data and knowledge then affect asset prices? So we talked about, how is that knowledge produced? And now we'll think about how is that knowledge used? And thinking about how it's used gives us a second measurement approach to try to back out what is the value of data. Next slide, please. Okay, so one of the problems with looking at the labor market view of what the value of data is they may be paying the analysts and these knowledge workers a lot based on some unrealistic expectations about what big data can actually accomplish, right? So the gentleman here, this manager, is saying after big data solves all our problems, we'll ride away on magic flying unicorns. And so, one reason you might want to go about valuing data in different ways is the concern that a manager like this might be overestimating the marginal product of data. Next slide, please. Okay, so here's the second approach. This is using a framework for data measurement that involves looking at asset prices. So this is going to be a really standard, it's a dynamic, noisy, rational expectation setting with heterogeneous assets. So there's going to be a riskless asset that pays R, and they're going to be N risky assets, and I'm going to index them by J. And these assets have cash flows. So we'll call the cash flows D. It's like dividends, and they've got some AR1 process, right? And GJ is the AR1 coefficient on the cash flows of asset J, but it's also going to regulate growth. Okay, so if that thing is big, you want to think about a growing firm where a little bit of cash flows increase today is going to compound a lot in the future. This is going to be independent across assets, so we're going to look at groups of assets whose cash flows are not too highly correlated. And each share is a claim to a future value. So you're going to get this future value of the asset. What is that future value? This is basically a Gordon growth formula. So it's R over R minus G times the expectation of dividends today. That's what comes out of this dividend process. And then, like all noisy rational expectations models, we only have a value for information. If information is not perfectly revealed by prices, how do we make it not perfectly revealed? Well, we put some noise in the supply, or you could call these noise traders, whatever you like. But that X bar part, the part that's non-random, is what we're going to call size. Okay? So lots of shares of an asset, that's a big firm, right? And we're going to map these growth and size and so forth to objects in the data. So then there are investors here. They're a continuum of one period lived investors. They're indexed by I. They've got mean variance utility. They're going to observe K signals. These are really data points, right? And data points are about cash flows, but they've got some noise. And then there's going to be some market-wide information, and that's the sum of the number of data points integrated over everybody in the market. So it's basically how many units of data does the average market participant have? That's KJ. So it's how informed are we? Okay? And then there's an equilibrium. So we got to have optimal portfolios and market clearing. So aggregate demand is equal to aggregate supply. Okay, so that's the whole model in one go. Next, please. So here's what we estimate. What comes out of this is, almost every noisy rational expectations model has a linear pricing equation. So here, price of asset J at time T is a constant. It's asset specific. That's that AJ thing. And then it's got a multiplier on the cash flows, right? That's what's in those square brackets there. And that multiplier depends in part on how much do people know, right? If nobody got any data about future cash flows or about today's cash flows, price is not going to be very responsive to cash flow innovations. But if we know a whole lot about future cash flows, then we're going to be much more responsive to that cash flow needs. And then we've got the noise in prices. That's the CX term at the end. So that the precision, that's that piece that shows up in prices, depends on our prior information, how much did we all know before, depends on market information, how much can we learn from prices, and it depends on the amount of data, most importantly, that we have. Okay? So that'll be the second equation we use. So we're going to do this regression of prices on a constant and on cash flows, and we're going to have a residual. Noise is a residual, and then from that coefficient, it's also often called price informativeness. That's the P in the third line. We can break that out into a piece that represents volatility, a piece that represents growth, and a piece that represents information. Okay, so now we're going to estimate this pricing equation, figure out a P-inf, and break it down into price informativeness, its volatility term, its growth term, and its information term. And then we'll break information into prior information, market information, and data, and try to gauge, like, where is information going and how valuable might it be. Next. Okay, so here's what we get out of the result of that estimation. So what we see on the left is the total market information, or the total amount of information embedded in asset prices. And you see 4 lines. Okay, so the text there is unfortunately very small. So let me tell you what they are. This is large growth firms, small growth firms, small value firms, and large value firms. So we're doing a fama French kind of exercise where we're putting firms into bins, and then within those bins of assets, estimating the information and their prices separately. Why are we doing this? Well, we're trying to figure out where is the data going, right? One of those questions I posed was, which assets are all these data managers and analysts looking at, or which firms are they looking at? What are they collecting data on? And what you see from this is that the increase in data is primarily about large growth firms. Other firms we're not learning a lot more about now than we were in the past. And this is true about the total amount of information embedded in prices. It's true for the information learned from markets. That's the information that one can extract from prices. That's like what Davila and Parlatore look at. That's basically that middle panel is their metric. And then our metric, which is how much data, how much underlying data seems to have been acquired and processed about each of these assets. So all of the increase seems to come from these large growth firms. Next, please. Okay, so now that we know where the data went and how much data seems to show up in prices, we can go back and say, well, you know, we've got this structural model. We can say, how should you value data? And the value of data includes, you know, both the risk, right? If there's an asset that's more risky, getting a piece of information about it is much more valuable. If it wasn't risky at all and its future cash flows are really easy to predict, getting an additional piece of data, it doesn't do much for you, right? So uncertainty makes data valuable. And that's the first term in the value of information. And then the second piece is growth. So growth makes information valuable because growth is about like how steep is the trajectory of those cash flows. And if that's a very flat trajectory, then a little bit more cash flow today doesn't translate into a lot of net present value in the future. But if those cash flows are growing quickly, then a little bit higher cash flow today means even higher tomorrow and higher the day after that and so forth. So growth is compounding those innovations. So basically, growth is regulating the sensitivity of firm value to news about cash flows today. And lastly, size. So bigger firms are more valuable to learn about. The reason is that a bigger firm must feature more prominently in the average investor's portfolio. Because if it didn't, the market wouldn't clear, right? Somebody's got to hold all of these shares. And so if there's a lot of a risk out there, there's a lot of a firm out there, then it's going to be something I'm likely to hold more of, and that data will, therefore, about that firm will be more valuable to me because I'm more exposed to that risk. So risk, growth, and size. And so we can back this stuff out from our structural model, each of these components, and recombine it to formulate a value of data. Okay, so again, this is the value of data, or the value of information, VI, for those four categories of firms: large growth, small value, and large value. And all four are actually plotted on this graph. You just can't see small growth and small value because they're really, so much lower than the value of data for those large firms. So for most of the period, the large growth firms are more valuable to learn about. And that's really reassuring because what we just saw was that it seemed like most managers were, most financial market participants were in fact learning about large growth firms. So it made sense that, those were actually seemed to be the valuable ones to learn about. There is one period in which large value firms dominate, and that is largely determined by what's happening during the financial crisis. So if you knew the financial crisis was about to happen, you should have stopped learning about large growth firms and started learning about large value firms. And if you'd done that, that data would have been a lot more valuable. Of course, we didn't know the financial crisis was coming, so it kind of makes sense that we were still learning about large growth firms during that period. We just couldn't anticipate that surge. So what's making this value so high? The reason we barely see the value of data for the small firms is that if you think about these three terms that determine the value of data: risk, growth, and size, risk varies a little bit for these firms. It's true the smaller firms are riskier, and all else equal, that would make their data more valuable. And it's true that growth firms, well, they've got a higher growth term, but size is hugely different. And it's fanning out. It's becoming more different across large and growth. So large firms are getting a lot larger relative to small firms. And so you see this divergence in size, and it's of just a much greater order of magnitude than the changes we're seeing in risk and growth. So that big divergence in size of large firms versus small firms is causing a divergence in the value of information. So, large firms have way higher value. And then the other thing to notice is that growth multiplies size in that formula at the top. And so to the extent large firms are more valuable to get data about, large growth firms are even more valuable, right? So it's amplifying those changes in size. Next, please. Okay, so here, this was another way of thinking about what's the value of data, right? The first approach said, let's look at how many data workers is a firm hiring, what are they willing to pay them, and what does that reveal, right? It's a revealed preference approach. What does it reveal about how much they must value that data? And here instead, we're saying, well, what is the data that's contained within asset prices, and what does that reveal about what people must have acquired, right? And so this second approach has its own open questions. Public data or partially public data should have a different value from information that's more or less private or not known to many market participants. So how might we think about that, and whether people are getting this, this public data, and how should we adjust the formula for the fact that other people might be observing it? What kind of macro information, what about macro information that matters for all assets? We are thinking of, really firm-specific data. This is data about, a large growth firm, not about the economy as a whole. But there's a lot of data about the economy as a whole. So we want to, develop methods to value that stuff as well. How does the data fluctuate, or how does it co-vary with equity prices, right? So we're starting now to think of data as an asset in and of itself. And so if it itself is an asset, how we value it, we might want to start thinking about how its value fluctuates and how it co-varies with the market. And we might end up thinking about what are the betas on different types of data as well. So again, we got to extend theory that one step further. We know how to price assets. We know what tools to use to think about how much they're worth. We want to extend that now to data. And then this valuation is for data that's used for only one purpose. It's only used to allocate capital, right? And we know that that's not the only thing that firms do with data. They use it for marketing or, for product development, all kinds of other things that they might use data for. So, how can we make richer models to value data and firms that use it for multiple purposes? Next. Okay, so in conclusion, data are the new assets, right? This is an exciting frontier, but we got to think about now, okay, we know how to price traditional assets, but how do we price this new stuff? How do we value it? How do we choose it, right? So data choice is the new portfolio choice. But in order to choose it, I have to think about how I value it. I don't know what to choose if I can't put a valuation on any of this stuff. So there are a lot of ways to value data. We explored just two of them. They're by no means the only ways to go about it. The first was revealed preference in labor markets. How much must it be worth if we're willing to pay this much to produce it and to work with it? And the second is how much return can I earn from knowing this data? And that turns out to depend on the return you can get from a unit of data, depends on the asset size, its growth, its volatility, as well as how much others know about it. So this is a really exciting area. There's a lot of work still to do in this area. We're basically, trying to reinvent finance theory and apply it to data. And along with this, we'll need lots more measurement as well. So more theory and empirical work is needed. And that's a great thing for all of us that are interested in this topic area. We needed to understand what is happening and why and how we see this evolving in the future. Next slide, please. Okay, so lastly, there's been a lot of talk about AI being used to generate song lyrics. So I got to thank Eric Brynjolfsson for bringing my attention to this. If you take the text of these papers and you feed it to an AI bot and you ask it to write lyrics in the style of Taylor Swift, here's what you get. How are we going to govern our behavior when we're all connected and no one is respected? The shifting in the ways we produce knowledge is changing the way we govern and the way we live. So what are you going to do when the knowledge factory has no floor? How are you going to run when the knowledge factory is in the cloud? Then everyone's a teacher and everyone's a student. So there you go. There's some AI in action showing the fun side of what we can do with new data technologies. Thank you.
Thank you, Laura. That was outstanding. It's just so rich with insights and thoughtful comments. So I invite the audience to ask questions either through the Q&A or through the chat. Let me kind of start off this process. I have a question of my own. So at the end, you talked a little bit about, thinking of data itself as an asset rather than as an input into something, right? And that seems to me, highly relevant. You already have, trading exchanges where perhaps the largest component of the revenues actually coming from just selling data, right? And there's a marketplace for data too, sort of, as we all know. So in terms of conceptually thinking about, in terms of framework of thinking of data as an asset, so what would be the ingredients of that?
So, there are lots of questions. There are lots of answers that are running through my head. There are a lot of ways to approach that, right? And so, this highlighted too. In both of these models, data was an asset. It was something that was being accumulated and that we could value. And in one case, we were thinking of data being, kind of out there. The first view is sort of like data is just like, grass growing in a public field, and it just takes work to harvest it. But it's the raw data is freely available out there. And that's not quite right? There's certainly people who are paying for data that is not currently integrated into their data management system. But it is true that even when you pay for data, there's still a lot of work that's involved in making it right for your purposes. So, I'll give an example of anybody who's done empirical work. Almost none of us got the data and we're like, hey, this is perfect. It's in exactly the form I need to run my regression and get the insight I was hoping for. Let's just hit run, right? That just never happens. Instead, we spend, weeks, months, years sometimes cleaning and processing and assembling it and getting it in the form we need to get the insights we need. So, firms have to do the same. So, there's this raw data as an asset, which is, kind of what you're talking about trading on exchanges. Not that it's totally unstructured, but it might, we buy unstructured data and still have to we buy structured data and still have to do a lot of work with it. And then there's the data that's in the integrated knowledge management system of the firm in exactly the form that they need it. That's going to have a different price, right? And you could sort of think of this as like adjustment cost for capital. There's uninstalled capital, and then there's the capital that the firm has paid the adjustment cost to install in their firm, right? And it's kind of similar. So, that's one way to think about it. But then, of course, the other way to think about it is well, from the back end, how much profit can I make? Well, what am I going to do with it, right? And so the second piece was the first piece didn't really take any stand on what anybody did with knowledge. It just was, if I'm willing to produce it at this cost, it must be worth that much. And the second piece said, I have no idea where knowledge came from, but here's what I think somebody will do with it, and here's how much profit they can make from it. And so you could also value it, right? There was a value function that had data as an asset that was long-lived, and it had the evolution equation, and it gave you, a different answer. And so, these are two different ways of going about it. And we see that when we value capital as well. There are people who value capital by thinking about what's the investment cost that got us to that capital stock, and there are people thinking about capital as, well, how much value is it generating given that it's being used to produce in this or that way. And so we're just trying to do things that are analogous, but do it for data.
Okay, thanks. Let me see what questions are popping up here. Okay, so I don't still see anything. So let me ask you another question. So, you kind of, the way you presented it, you're looking at the returns from data, right? Mm-hmm. But you have this asset pricing framework, so underlying all that, there's also a risk. Mm-hmm. So that's a big thing, with AI and data, which has the risk to do with, privacy and with cybersecurity and so on. So how should we think of risk, in the frameworks that you're presenting today?
In the framework that I was presenting today, the only risk came about because of the contents of the data. So that the worst thing that would happen is the data tells you exactly what you thought would happen anyway, right? Because then it didn't really deliver you. It would still, I guess, reduce your uncertainty a little bit, but it wouldn't generate a whole lot of value because it wouldn't change what you're doing, right? That's not the only source of risk, as you point out, right? There's the privacy issues and so forth, and that's not really captured in this framework. Now, could we extend this to think about that? Yeah, I think we could, and you'd want to start thinking about, what is that? What are the determinants of that kind of risk? So, does having a bigger data set mean that you're more likely to be hacked, or does having a more valuable data set increase the probability that there is a disclosure, or if there's a disclosure of that data, it's more impactful, right? So we have to start thinking about what are the characteristics of that risk and trying to build it.
Okay, so we do actually have one question from the audience, and so the question is, is there sort of really a sharp demarcation between like OT and AI? And one example would be, say you have someone working in a warehouse, so even like learning a crane or something, but you could have some kind of computerized technology or AI stuff kind of built in, right? Yeah. So just empirically, perhaps, how easy is it to sort of say, okay, this is the value I'm getting from OT, and this is the value I'm getting from AI.
Right. So, I mean, any time we do empirical work like this, there's never a bright line going right down one bin and another, right? And so we're sorting things imperfectly, like anyone else did. That being said, the word pictures that I showed you, I think to us were kind of striking because they did look quite distinct. So if we had, the algorithm was going to give us 2 bins of jobs, no matter what we did. But if it was a failure, we would have looked at those 2 pictograms and seen words that looked fairly similar. So for example, you can have the same words showing up in both, right? There's nothing that says you can't, and you do. It's just that in some cases they're a lot bigger, and in some, in the other picture they're a lot smaller. But overall they looked quite distinct. But absolutely there are cases in the middle, and what our algorithm is giving us is here's a probability that this posting belongs to this category as opposed to the other one. But there are a handful of jobs in the middle. But there are quite a few of them that are quite distinctly one or the other. For the most part, a firm is either looking for someone with that data science skill, or they're not. And they're not generally looking for someone who's like pretty good at doing models with Stata, but also kind of good at Python and Hadoop,
right.
That's a little neither here nor there.
Okay. So there's another question here. This is to do with the implication. So you had this result on the effect of size. And sort of the implications of that in terms of this idea that big tech is getting bigger and bigger, and the markups are getting bigger, and in some sense the economy is sort of getting less competitive. Does that sort of follow from that or not?
Yeah. I actually think of that even more related to the question of what was the production exponent in the beginning. Because if what we're seeing is that there's less diminishing returns to data, that means that an optimal firm should have a lot more data and it should be bigger. And that there are going to be a lot of returns to a few really big data intensive firms. This looks more like, the big industrialization manufacturing plants as opposed to the little artisans, each with their own tools, or in this case, their own data models that had a lot of diminishing returns to data, right? That was kind of the pre-AI world. It was really decentralized. They had a lot of producers doing their own little, think of this as like boutique firms that had their own way of doing things, and they were generating value in their own way. Now it's really difficult for a boutique firm to compete because the AI is becoming more productive, the AI algorithms, but in order to use them, you just need a ton of data. So you need to operate at a different scale. And so I think it's frightening from the point of view of competition. And it's what it means is that data providers are starting to look more like utilities and maybe less like the little startups that they started out as.
So I mean, so the reason that Amazon or any of these companies are getting bigger Is it because they're scaled more? So because they're scaled more, they can use more data? Or is it that they can just use, so once they reach a certain scale, there's some increasing returns to scale where they can just utilize the data more efficiently. So they can take some amount of data and then they can use it in a lot of different ways because they're doing so many different things.
I don't think there's increasing returns to scale to data, but it is true that once you have a lot of data, you're more likely to adopt this other technology, right? So if you're data poor, you're kind of like the artisan and you're best left doing handiwork, right? The artisanal production. But if you've got a lot of capital, you become the manufacturing plant and you operate at a different scale. Same thing. So Amazon's operating at a different scale with a different technology. They're using a ton of AI right now. So, it's not that data always has increasing returns. Given a technology, given old technology, the next marginal unit of data is more less valuable than the last one. Given an AI technology, more and more data has less and less marginal value. But the AI technology requires a lot of data to use. So you got to be really big to use this great new technology. And so I think we are likely, this happens it happened with industrialization, right? That was the era of the robber barons and the, big firms crowding out little, artisanal producers. And we're seeing something similar happening now.
So in that case, there was potentially, new entrants and new technology was breaking, which broke that competition.
Yeah, so, maybe we'll see again, some new innovation that disrupts all of this. That has happened many times. I'm not going to go there and try and predict what that might be. I don't have that much of a crystal ball.
Okay, so let me check if there's anything else here. Okay, so there's a question here that some would argue that AI is last mile and requires prior data infrastructure investments. So while the two firms may be hiring in the AI category, it's possible they're getting different returns for that hiring.
Trying to interpret that question.
So I guess the idea is that you have two firms, they're both hiring AI people. They may be getting different returns because I guess it requires some other infrastructure to utilize the data.
Okay.
And so, so I guess you could maybe, one way to think about it, like if you have the same AI expert and was hired by firm A versus firm B, the productivity of that expert might be different in the two firms.
Right. So maybe you need like really good computers or some kind of specialized capital, for example.
Yeah,
absolutely. I think, we thought about putting capital in here. First, we don't have good data on it, right? We don't know exactly what, we can see CapEx for, a firm, but a lot of that's not necessarily going to computer equipment. And then the other is that, the information we did see seemed to suggest that the expenditure on a computer is just way less than the total labor wage bill. And so we decided to leave it out, in part for practical reasons and in part because we thought, look, you can throw everything in a production function, right? You could have the kitchen sink in there too, and it's going to help keep everybody hydrated, but you don't want to put that necessarily in a simple model for measurement. So this one's not quite the kitchen sink. It's much more closer to stuff that that actually matters. But we made the call that seems small enough to neglect it. But if we'd had really good data on exactly what they're doing, it would be more interesting to include it. And I just include it by having it as a third factor, right? We'd have data to the alpha and capital to the psi and labor to the 1 minus alpha minus psi, and we'd go estimate these things. I don't think that's going to be a big enough factor of production that it's going to overturn the results that production with AI looks pretty good.
So we are, okay, so this is from Jared Hauberg. And so his question is, does the model fitting have any predictions for when the steep upward trends in AI data capital accumulation will slow? And how much of a firm's long-run steady-state capital will ultimately be AI versus OT?
That's a good one. I think in this economy, I guess there is a long-run steady state. We hadn't thought about. I guess I'm thinking about the first model, right, where we've got AI and OT technologies explicitly, and we hadn't thought about it as steady state because we were trying to estimate what right now seems like very clearly a transition path. We're just at the beginning of AI hiring. But I think he's right that in the steady state, you would still have some old technology production because you'd be using the diminishing returns wouldn't have set in. And so you would get to some optimal mix of the two. That optimal mix is going to be much heavier on AI than what we see right now because, as I said, they're just in the beginning of AI hiring. We saw that only a small number of job postings still were AI. But that's an interesting question. We haven't computed that out, but absolutely both would coexist in the long run.
And there's a measurement question, which is saying that physical capital is much easier to measure and price than data analytics. So how does this measurement uncertainty affect your conclusion?
I'm not sure we estimate capital so well. Let's think about what's the valuation of the New York Fed building, right? It's never transacted. So we don't really know how much anybody is willing to pay for it. So how do we build that value that building that we're all looking at, on the screen? It looks lovely, but we basically value it at cost, right? It's not like you've got a ton of revenues and we're saying, well, how does the building contribute to the marginal value? We can compare it to some other buildings that look similar, but there's really none that's quite like it with that, size and that age and that style. And so we make wild guesses when we value capital. And I think we're very comfortable with the idea that capital has valuation just because we've been using it for so long. But I think we make inference about capital values using, structural models, using, making inference from seeing similar kinds of capital that may or may not be equivalent in various imperfect ways. And, I won't say that we've got as good a handle on the value of data yet because we haven't done it as many times in as many different ways. But I think conceptually the challenges you face with data are not that different. It's not because you can touch the building that it, gives you a dollar figure per brick.
Okay. And there's a question about data and firm size. So the question is, to what extent does data actually determine firm size? So I'm thinking about superstar studies on talent and firm size.
Yeah. Definitely there's a superstar kind of effect here because the kinds of digital or knowledge outputs that are being produced can be applied to many, many people or many, many other businesses or many, many shares of an asset. And so that essential feature of a superstar problem is present here. And that's part of why at the end I said size shows up in the value of data. If this weren't data, if this were like, pencils, right? Well, we need one pencil to write on one pad. And how big the pad is doesn't really govern the value of pencil that much. It's not like one pencil becomes more valuable because I got 100 notepads because I can only write on one at a time. But that's not true for knowledge. Knowledge can be applied to lots of value, lots of shares of an asset all at the same time. And so that is kind of the superstar effect. It's, data is like a superstar, and how valuable it is to be a superstar depends on the size of the market, right? So being a pop superstar is more valuable than, maybe being like a bluegrass superstar because it's a smaller market. And that's the kind of, the same kind of comparison we're doing with data.
Okay. So I think we've come toward the end of our session. Laura, thank you again very much.
Thank you, Hassan.
It was really awesome having you. And we look forward to seeing you soon in a less virtual setting.
My pleasure.
Okay. Bye-bye.
Bye.
So thank you, everyone. That's the last event of today. So I would like to remind you, we start again on October 1st, day after tomorrow, and there's a separate attendance link for that, which if you registered, you should have received. So thank you again for attending today's session, and I look forward to seeing everyone on October 1st.